A company can show profits. It can even grow fast. But the real question is, how efficiently is it using capital to earn those profits? That's what ROCE tells you. ROCE stands for Return on Capital Employed. It answers one simple question. For every dollar of capital invested in the business, how much operating profit is it generating? Capital here includes money from shareholders and money borrowed through debt. So ROCE looks at the entire business, not just equity. The formula for ROCE is operating profit divide by capital employed, multiply by 100. Capital employed usually means equity plus debt, or total assets minus current liabilities. Let's take a simple example. A company generates $20 in operating profit. The total capital used in the business is $100. That gives an ROCE of 20%. That means for every $100 invested in the business, it earns $20 before interest and tax. Whether this is good or bad depends entirely on the industry. Capital-heavy businesses usually operate at lower ROCE, while asset-light businesses tend to show higher ROCE. ROCE only makes sense compared within the same industry, not in isolation. ROCE is powerful, but not perfect. It can look temporarily high when companies sell assets or delay fresh investment. And it works best when comparing companies in the same industry and looking at trends over multiple years. 1 year alone can mislead. Investors use ROCE because it reveals business quality. It helps answer questions like, is growth coming from efficiency or just more capital? Is the business capital hungry or capital light? Is debt actually creating value? High and stable ROCE over time usually indicates strong competitive advantages, disciplined capital allocation, and durable business models. That's why long-term investors pay close attention to ROCE. Profit shows success. ROCE shows how hard money is working. If you understand ROCE, you're already thinking like a business owner. Follow Fineryx. Understand money better.